Good afternoon, everyone, and thank you for joining. We're going to let everyone continue to log on, and we'll get started in about a minute. All right, let's go ahead and get started. Hi, everyone. Thank you for joining today's webinar. This is the second of our Withum and Genova Burns joint webinar series for the cannabis sector, Planting the Seed, How to Overcome the Financial Leap and Other Weeds for the Winner. Today's program will focus on how to structure your cannabis business and take on partners and investors. Our presenters are Keith Krauss of Genova Burns and Ryan Brandt of Withum. Before we begin, I have a few notes. These materials can be found in the toolbar on the right of your screen. Also, at the bottom of the toolbar, you will see a chat. Feel free to send us your questions during the presentation. We will do our best to address them at the end. Once the webinar is over, there will be a pop-up asking you to complete today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to Ryan.
Thanks, Rachel. My name is Ryan Brandt. Today I'll be presenting alongside Keith Krauss. This is, as Rachel said, the second webinar in our four-part cannabis series with Withum and Genova Burns. So I thank everybody for joining. We hope to see you at our next two events. The purpose of this webinar is to explore different legal issues when forming a company and taking on investors, as well as the tax pitfalls that you might face. Understand that every business is unique with different goals and intentions. There's no one-size-fits-all decision. So instead, we'll explore the pros and cons of using corporations and LLCs so business owners can make informed decisions on structuring their business and taking on investors. I may say this a couple of times, but it's definitely best practice to establish a team of professionals to navigate some of these issues. You want to have trusted advisors right from the beginning. This is something that should be considered in the business plan before even thinking about the location of your business or going through the licensing process. You need to set yourself up for success in those beginning stages. So with that, I'll turn it over to Keith from Genova Burns, and he'll talk about some of the different considerations when forming your business. Keith?
Good afternoon, everybody, and thanks for joining us. My name is Keith Krauss. I am the head of the corporate and business law practice of Genova Burns. And thank you, Ryan and Rachel. As Ryan just said, we're going to talk and just touch upon some of the things that are out there that you should be considering as you form and raise money for your cannabis business. We're not going to get into specifics because, again, as Ryan said, each one of you has specific needs, concerns that will have to be fleshed out. But it is, as you'll see during the hour we spend together, this is complicated, and there are some competing interests, including corporate structure versus taxation and tax benefits that need to be thought through and considered to maximize your position and your protections. I also want to note at the beginning that under the act that was passed, or finally approved the end of February, regulations from the commission are due within 6 months, which would be the end of August. So when the regulations are promulgated, we're gonna have further clarity on specifics. The commission may, in fact, adopt regulations that are inconsistent or a little different than how we're reading the statute, but we'll have more clarity then. And as an example, just if any of you applied for a PPP loan last spring, we were knee deep in that, and we read the statute, and every time we turned around, SBA was coming out with a new proposed reg that gave us another twist and turn. So we were advising clients one way, and then having to back up or modify that another way. And we're expecting some of that here when the regulations are out. As Ryan said, not only in general, but especially as you're making an application in this space, strongly recommend that you have everything worked out in advance. You should start thinking about all of the issues we're going to talk about today right now, even if your license application is not going to be prepared for 6 or 8 or 12 months. We actually had a situation a couple years ago, the last go around on medical, where they were literally negotiating with an investor the night before the applications were due, didn't make a final decision on the structure of what the investor was getting until that morning, and we were literally hand delivering, driving down the turnpike and delivering that application to Trenton that day. And needless to say, they did not get approved because it just wasn't good enough, it wasn't thorough enough, didn't get enough points, etc. So start thinking about it now. Having said all that, let's start off with the basics. Generally, coming out of the gate, you have 2 primary concerns in terms of forming your business. One is limited liability, which means the debts of the entity don't become the debts of the owners. I like to think of it as the 3 little pigs. We want to be the pig with the brick house and everybody in the brick house. So when it rains, when it snows, when it sleets, when there are robbers out there, and when the big bad wolf comes to eat you, you're behind the walls of a brick house and nobody inside gets eaten or cold or anything else. And then the second consideration is tax treatment. And as we're going to explore, your tax treatment is limited and can depend upon your entity structure. And third, in a regulated industry like cannabis, you also want to make sure that you maximize your points, because the statute gives certain points for certain aspects of your business, including, in some cases, who your investors are. So you need to calculate that going in, and that creates a tension between your usual approach. If you're a regular non-cannabis startup, then it's all about the money, right? I'm going out there and I'm going to maximize the amount of money I can get and give away as little of my company as possible. In the cannabis space, since you're going for points and certain points are given for certain investors, you want to maximize your points. And, Ryan, I don't know if you want to weigh in on points. I'm going to talk about points a little later on also, but if you want to.
Yeah, definitely. So this is something I actually learned recently, that here in New Jersey, license applications will be scored and reviewed based on a point scale. The commission will determine the number of points and the point categories. So obviously, as Keith said, with the more points that you have, the better chance you have at obtaining a license over other applicants. Excuse me. One of the point categories is to determine, the applicant's financial plan. So this will no doubt take into consideration how you plan on structuring the business for tax purposes. You need to tell them whether you're going to be an LLC, incorporated, LP, whatever your structure is, that's going to be part of the business financial plan. So before you even incorporate or register as an LLC, you need to have this stuff sorted out before you even become operational. Another area to consider while we're on the point system is that you need to demonstrate the applicant's financial ability to implement a business plan, as Keith mentioned. This may include providing bank statements, financial statements, and even financial forecasts. So you need to have all this stuff in line before you even go to apply. I always find there's many circumstances where people, with access to financial resources, they'll jump headfirst into this with their business plan. In my opinion, this is a very aggressive way of planning out your business strategy. And it could lead to, making decisions that negatively impact the future of your business. So Keith, again, you really need to be diligent about drafting your business plan for purposes of this point system.
Thanks, Ryan. Going back to limited liability, what you really come down to is if you want to limit your liability and get everyone in that brick house, you need to be a corporation or an LLC. Limited partnerships, the general partner of a limited partnership is liable for the debts of the entity. So try and imagine the general partner is outside the brick house and subject to all of the weather and the big bad wolf. General partnerships are even worse. If you have a general partnership, each partner is individually liable for the debts of the business, and the same thing with sole proprietorship. So what we're really dealing with in terms of limited liability, especially in a regulated space like cannabis, you're going to be a corporation or an LLC. Next slide, please. We'll talk about corporations for a second. I'm going to talk from 10,000 feet real quickly. You have two types of corporations generally, and don't be confused. C Corps and S Corps are not different types of corporations. They're the same type of corporation, a for-profit corporation that has elected a particular type of tax treatment. You really have two types of corporations, a profit and nonprofit. I note here that you may come across a phrase called benefit corporation. You're not going to be a benefit corporation. Last 10 years, they've been authorized by statute. It's a for-profit entity that includes as one of its purposes in its certificate of incorporation and bylaws as certain public goods, as opposed to just pure profit. You're not going to do that. You're going to be a profit corporation. Now, in terms of considering whether you become a corporation or an LLC, understand that unlike an LLC, a corporation structure is established by statute. And that statutory structure is shareholders, unless you create different classes of shares, own common voting shares. They elect the directors run the company by appointing officers. Now, you can alter that structure by agreement. We're going to talk about that a little more specifically. And that's important if you have a corporation and you're trying to attract investors, because depending on the market, how much money you're trying to raise, and what your investors want in return, you can give away some of those rights. So for example, the statute says if you have one class of voting common, all the shareholders elect directors by percentage. So if I own 51%, I can elect all the directors. You can alter that by agreement. And again, we'll get into that a little more specifically. If you form a corp, you're then going to call Ryan and say, should I be taxed as a C Corp or an S Corp? And before I let Brian talk about the differences, I want to tell you that there are, from a corporate legal standpoint, negative considerations if you elect to be an S Corp. Specifically, your investors cannot be, if you're an S Corp, a foreigner. They must be a natural person. That means that no entities can be a shareholder, and you can have no more than 100 shareholders. That, as a practical matter, means if you elect to be taxed as an S Corp and a private equity entity, an LLC or a corporation wants to invest, they can't do that if you're an S Corp. And Ryan, you want to weigh in on the differences from a tax standpoint?
Sure. Yeah. So starting with the C Corp structure, a C Corp is basically a legal entity that's separate from its owners, as Keith mentioned. So unlike partnerships and LLCs, corporations pay income tax at the corporate level, which is currently 21%. This is an entity level tax. It's not a flow-through tax. Shareholders are not personally responsible for paying the tax at the individual level. However, if a shareholder decides to take a distribution from the company or withdrawal from the company, they will be personally taxed in the form of a dividend, which is currently a 20% federal rate and a 3.8% net investment income tax. So 23.8% on top of the 21% corporate rate. So let's say a shareholder pulls out $100,000 from the profits of the corporation. That $100,000 is taxed first at the 21% corporate rate, and then again, it flows through to the 23.8% dividend tax at the individual rate. So the government essentially got in that transaction 44% of tax in that $100,000, $44,000. So that's a prime example of double taxation. So income is taxed on the same source of income twice. Now, when we think about cannabis companies, right, although double taxation is unfavorable in certain situations, if a cannabis company is looking to grow and they want to reinvest their profits into the company, and they're not planning on taking distributions for a long time until they're profitable, they're able to lower their corporate tax rate. I mean, they're able to take advantage of the low corporate tax rate, 21%, and they're not taking distributions from the company, right? They're not getting that dividend tax, the individual level. So those are some things you want to think about. And also, not even double taxation. If you think about 280E, which I'm going to get into later, this is an unfavorable tax treatment for cannabis companies. And if you're subject to 280E, you're subject to dividend tax and you're subject to corporate tax. That's almost triple taxation in a sense, which could be pretty detrimental to a company in terms of taxes. Now, looking at the S Corp structure, Keith went into a little bit about the pitfalls of creating an S Corp, but the issue here is there's no double taxation. You could take tax-free distributions from an S Corp. There's no S Corp tax rate, unlike the 21% C Corp rate. But how are you going to take money out of the company? Well, shareholders are actually required in an S Corp to pay themselves a reasonable salary, which is at least what other businesses pay for similar services. You can't pay yourself, let's say $10 a month as a CEO of a billion-dollar corporation. That's not reasonable. The compensation is going to come in the form of W-2 wage, which means you'll be subject to Social Security and Medicare tax. That's how they get you in the self-employment side. You can also take distributions from the company. They're not the same as the C Corp dividend distributions. S Corps are able to make tax-free non-dividend distributions. However, you need to keep in mind that if you're taking these distributions, you need to have basis in the corporation, or else those distributions in excess of basis could actually be taxed at long-term capital gains rates. So there's a lot of things to think about. There's a lot of moving parts, just trying to figure out whether you want to have a C Corp structure, an S Corp structure. It really depends on what your plans are for the future. Are you going to be taking on investors? Are you going to be pulling money out of the company? There's a lot of factors that weigh into these decisions, and you really want to get in front of them before you actually become operational and profitable.
Yeah, I just want to mention to Ryan's point, I formed a craft brewery company a couple of years ago, and formed them as an LLC, and they elected to be taxed as a C Corp, much to my surprise. And they did that because their business plan was not to pay their investors dividends, but rather to retain the earnings and to ultimately use those earnings to expand into other locations in other states. So the point here is decide what your business plan is going to be. And again, that will be driven in part by what your investors want and what you need to do to get to them. If they say, listen, we want regular stock and we want certain rates of return in the form of dividends, then you're probably going to want to get the benefit of S Corp treatment or partnership tax treatment through an LLC, because it's about a 10% swing between S Corp tax and partnership tax and C Corp tax.
Right.
Next slide, please.
And to your point, Keith, there's a, if those employees of the brewery, they wanted to take a W-2, they could also take wages, and then the corporation could write off those wages as a deduction. So, and you could also
yeah, that's right. Good point.
Options, right? You could have stock options where there's no out-of-pocket expense. They just get a share of the company for services rendered. That's something that we can get into with restricted stock units, incentive stock options. These are all good ways of compensating employees, especially if you're a startup and you don't have the means to be dishing out a lot of funds up front for salaries and wages and distributions, et cetera. So things to think about when starting a business.
Now let's turn to LLCs, limited liability companies. They're a relatively new form of entity. They popped up in the early 90s, and there's a lot of misinformation out there about LLCs, and hopefully I can correct that. And in case you don't pick it up implicitly, I'll tell you up front that I am a big fan of LLCs over corporations for reasons that I'm going to describe. Generally, with an LLC, unlike a corporation, there's no statutorily prescribed structure. You establish your structure, and when I say structure, I mean all aspects of your business, from governance to economics, how your investors get paid, how your employees get paid. All of that is established by agreement of the owners, which are in an LLC called members, and corporations they're called shareholders. This agreement is commonly called an operating or limited liability company agreement. This gives an LLC maximum flexibility in terms of structure and governance. Again, the corporation, their basic structure is shareholders elect directors, directors pick officers. You're required to have an annual meeting of shareholders and directors. In LLCs, there's no such thing. You do it by agreement. You don't have to have meetings. You can structure yourself internally like a partnership where all members have an equal vote. You can structure yourself internally just like a corporation where the members elect a board of managers. You can construct yourself internally just like a limited partnership where a member who has 1 or 2% ownership is appointed manager and acts just like the general partner and runs the show, and the other 98% don't have any say whatsoever in the running of the business, or they have a say in only certain issues. Or if you want to give the 98% some voice, you form a board of managers of 3, and the 98% members elect 1 board member, and the founders that own 1 or 2%, they select the other 2. There's total flexibility in how you structure yourself, and I like that. We as lawyers like that, and in fact, investors like that. You can also do whatever you want in terms of economics. So you can have waterfalls of distributions of profit. That means certain members, and you can create classes of members through units. They get money first before other members. And that will give you the ability to create, some of you may have heard in the context of corporations, preferred shares, non-voting shares that get a preference in terms of dividends. You can create the same thing through LLCs. If you don't have an operating agreement or an LLC agreement, you're governed by state statutory provisions which apply by default, which you may not like. As an example, in New Jersey, absent an operating agreement, each member has 1 vote regardless of their percentage interest, like a general partnership. The states differ in terms of whether you must have a written agreement and what the default provisions are. The other thing I love about LLCs, which you do not get in corporations, where you're either going to be taxed as a C Corp or an S Corp, LLCs, you can elect to be taxed however you want. You can elect C Corp, S Corp, disregarded entity treatment if you have 1 member, or partnership tax treatment, up to you. That's a big advantage. And in fact, as Ryan will tell you, you can change your election over time. There may be some tax consequences to that, but you can change your election. Next slide, please.
Changing the election in terms of taxes is something going from like an LLC to an incorporated, LLC to Inc. So you would need to convert your balance sheet to a tax basis, make sure there's no built-in gains on the way over to the incorporated entity. But for tax purposes, right, the LLC, like Keith said, could be formed as a partnership or an S Corp. Both types of these structures are considered pass-through entities for tax purposes. meaning that the LLC, the income or loss generated from the business, again, will flow to the individual partners and tax at their individual rates. Keith was mentioning how there's flexibility. There's also flexibility in the tax world. So you have the ability to take uneven distributions, and they don't have to be pro rata like in an S Corp. They don't have to be based on partnership percentages. And then the partner is actually taxed the individual ordinary rates. For partnership, it would be self-employment tax on that income. So the self-employment piece is really what sets partnerships and LLCs apart from the S Corp taxes. Partners are subject to ordinary rates along with Social Security and Medicare tax on the income. However, partnerships, they don't need to take a reasonable salary like S Corps. They shouldn't be taking a salary, period. Their salary is in the form of a draw or a guaranteed payment. There's also the single member LLC structure. This is where you just have one owner that owns the business. They're more commonly known as a disregarded entity for tax purposes. So typically single member LLCs are, the mom and pop businesses. They don't have to file a separate tax return. All the profits and losses get taxed at the individual's ordinary and self-employment tax rates directly on their individual tax return. So you'll see that on a Schedule C, where you report the income and expenses from operations. It'll flow to page 1 of your 1040, just as any business income would, and you're taxed at the ordinary rates. I don't typically see too many cannabis companies becoming a single member LLC. Typically, they like to bring on investors. I mean, if you're lucky enough to have enough capital up front and you could run that business yourself and not have to take outside investors, and yeah, single member LLC structure would be the easiest, most cost efficient. There wouldn't be any filing fees associated with a separate tax return. But again, LLCs, very flexible, very easy to maintain, and for tax purposes, we're definitely seeing more and more of them come on board, as Keith mentioned.
Yeah, and I didn't note earlier that unlike S Corps, LLCs can have business entities, other corporations and other LLCs as members, as owners. So that I think is a big advantage if your investor is an entity as opposed to an individual.
Right.
So the pros and cons of corporations versus LLCs. One advantage that I've been running across, I'm in the process of, we formed a startup that's going to creating an app in the social media space, and we just converted them from an LLC to a corporation because what their members have found, their founders, is that the people they're talking to in terms of investment, they prefer corporations because they know the structure. They know the basic statutory scheme, and they know that when you deviate from that, you're going to enter into certain various agreements that I'm going to talk about later, investor rights agreements. You're going to create classes of shares that will define rights that can deviate from that basic structure. With an LLC, you have to sit down and read the whole operating agreement because there is no basic structure. You don't know what it is going in. And I think there's a bit of laziness or not wanting to put the time in or the effort or making a mistake on the part of big investors. In addition, you learn something new every day. I recently was an attendee at a venture capital update webinar. And one of the speakers noted that from a reporting standpoint, a number of institutional investors do not want partnership tax treatment in an LLC because it involves potentially numerous state filings. We haven't talked about the fact specifically that Ryan alluded to it. If you elect to be taxed, if you're an LLC, you elect to be taxed as a partnership, you get that 10% advantage without double taxation, but each member gets a K1. And that may involve certain filings in terms of income filings in various states, depending on where these big investors are. And this speaker said they just don't want to deal with that.
Yeah, and
So-
don't forget about the LLC fees on top of that per state. So California actually has an $800 LLC fee that's annual. And New Jersey, you have the minimum rates for LLCs. Just the fees alone, you know, it could be a burden if you just have an LLC with no activity. You're still paying the fees. So that can be burdensome too. And you still have to file the returns, and you know there's separate filings. And like you said, K1s, a lot goes into it. So you got to think about those things.
Got to think it through, right? LLCs, as I mentioned, have the most flexibility in terms of structure and governance. You can choose how to be taxed. Limited or no disclosure of principals. We haven't talked about that, but when you have corporations, many states require you file annual reports where you disclose directors and sometimes shareholders. In many states, you do not have to disclose any of your managers. By the way, I use the word managers. Manager is the word used in LLCs for what amounts to a director in a corporation. The members typically elect the manager, although they don't have to. They can be appointed by the operating agreement. And the manager or managers run the company like directors would in a corporation. In many states, including New Jersey and Delaware, you do not have to disclose who your managers or members are. That can be very appealing, especially in a regulated industry where your investors don't want the public to know that they're invested in a cannabis business. The other advantage, when you create new classes of shares in a corporation, you must amend your certificate of incorporation. That costs you money, and it's also now a matter of public record. In most states, you don't have a need to make any filings to create new classes of membership interests. You do it internally by an amendment to your operating agreement. And the last thing, and I'm a member of the ABA subcommittee of the business law section on LLCs, partnerships, and unincorporated associations, and I typically attend their annual meeting, which is a two-day series of meetings and seminars. And the professors at the law schools that attend, that created LLCs, push the idea, have drafted all the model legislation. They take the position, and I believe it's starting to come out in case law, that one of the classic bases for piercing the corporate veil, piercing the corporate veil is a doctrine that says that even if you have that brick house and everyone's inside, the wolf can knock the wall down and get to the individuals. And it basically is based on some bad acts by, if you have a corporation or an LLC and you engage in some not so good things, then the wolf can knock that wall down. One of the bases for knocking the wall down has traditionally been failure to follow quote unquote corporate form. You don't have annual meetings, you don't have minutes, you don't pass resolutions, et cetera, et cetera. But since you don't have a statutorily required corporate form in an LLC, that basis for piercing the corporate veil and knocking that wall down is eliminated. So that's another advantage to an LLC. So as far as I'm concerned, unless you're going public within the next 6 months, which you can't do with the cannabis business at all, unless the feds do something to change the law. So that's out. Or you have big investors that prefer a corp over an LLC. I would recommend that you form an LLC because it gives you all of these advantages, gives you the flexibility of internal structuring, gives you the flexibility of choosing how to be taxed. And I will tell you, I think we handled 8 applications in the last go around for medical licenses. All of them were LLCs. Next slide, please.
Keith, is there any benefit to being a C Corp that's an LLC, or is that just overkill?
You mean an LLC that's taxed as a C Corp?
Yeah.
Well, like I said, the craft brewery, they elected to be a C Corp.
Right. They didn't change their LLC designation?
Well, no, you remain an LLC. You don't need to convert your structure. You just change your tax election.
Right. So they just converted, and they kept the same name, maintained the LLC designation. And
Correct.
Okay.
In fact, when the 18 Tax Act was passed, I sit on an M&A roundtable, and there are 3 accountants on, and one of the accountants made the point, not to get in too far into the tax, but the acronym QBI, Qualified Business Income, and one of the accountants was saying, I have a bunch of clients that don't have QBI, so I get no advantage from tax treatment anymore. I'm going to maintain the LLC, but I'm going to change my tax election to a C Corp. So yeah, I recommend.
They must have been a specified service company that doesn't get a QBI, the benefit of QBI, or they didn't have income.
And for those of you out there who don't know what we're talking about, qualified business income is something that was put into the tax amendments in 18, because when they reduced the corporate rate from 35 to 21, they eliminated theoretically that 10% advantage to being taxed as a partnership. So in order to preserve that, they created a qualified business income deduction. So if you are in most industries and your income qualifies, you can deduct that income and get the 10% benefit of being taxed as a partnership over a C Corp.
Yeah.
But again, I would recommend,
yeah,
even if you want to be taxed as a C Corp, that you're an LLC.
Right.
Because the governance and structuring advantages are still there, and the lack of reporting, et cetera. Next slide, please.
Hey, Keith, I just want to mention, since we're on the cannabis topic, Section 280E is a big deal to a lot of these companies out there. There's a lot of unfavorable tax treatments for cannabis companies. So I just want to throw it out there that Section 280E, it does not care what type of business entity you are. You could be a C Corp, you could be an S Corp, you could be a partnership, whatever. It's still going to be subject to this code section. So what 280E is, it denies cannabis business income tax deductions for ordinary and necessary business expenses. You're only allowed to take cost of goods sold with 280E. So all those below the line deductions are off the table. And I've gone through this in our first series with Genova Burns in detail. So you can look back at that if you want to look at some more deductions for 280E. But if you're fully vertical, seed to sale, which means you're licensed in every area of cannabis, growing, producing, selling your own products, there's valid reasons to establish multiple entities. For instance, like a holding company with separate real estate management, cultivation, and dispensary companies underneath it. However, you need to keep in mind when forming these separate entities, Keith, the IRS is going to look at substance over form for tax purposes. Meaning if you think you could create multiple legal entities to skirt Section 280E, you may be creating nothing more than a sham transaction, which is actually the words that the IRS uses. So substance over form, it's a tax law doctrine that requires transactions to have substantial purpose aside from reducing federal taxes. If it's just a shell company, there's no practical business entity, then regulators will prevent you from treating operation as its own. What's the true intent of the business? What are the expenses related to? If you could trace them back to the plant touching company, chances are they're going to be subject to 280E. So going back to that point system that I talked about earlier with Keith, here in New Jersey, the license applicants are actually required to demonstrate a plan to comply and mitigate the effects of 280E on their businesses. So you need to have that plan in place before you even go through the licensing process. And hopefully in that plan, you don't have a shell company that the sole purpose is to take on non-deductible 280E expenditures. Just a thought, just wanted to throw it out there. So go ahead, Keith.
Yeah, and I apologize, Rachel, can you go back to the previous slide? Let's talk about types of financing and securities. You have 2 overall types. You got debt, which is getting a loan with a fixed rate of return. and equity, and there are hybrids. These days, a lot of institutional investors, PE firms, venture capital firms are going with convertible notes, which is a hybrid. It's basically a loan, but it can be, and in some cases has to be converted into shares of stock upon the happening of certain events. I divide rights involved to an investor into two main silos. One is governance, or the right to participate in the running of the business. That is, vote for directors or managers or on decisions. And the second is economics, the right to recover your investment and get a return on investment, whether that's by way of non-liquidating or operational dividends or distributions, or a liquidating payment when the company is sold. And within those overall silos, governance and economic rights, there are many sub-rights. And I'm talking about these because these are the things that you're going to have to kind of slice into when you decide what you're going to give your investors and or what the investors want. Type of security, investor may want, you may get a big investor that says, no, I don't want your voting common, I don't want your cumulative preferred shares, I want a convertible note. And depends on how badly you need the money and how much money the investors are willing to give you as to how much leverage you have on that. You have to consider the amount of the investment, price per unit per share, economic rights to dividends. You have cumulative versus non-cumulative, governance participation. You have a right to vote for directors, managers, decisions, rights upon liquidation. Are there any preferences? Will the company reserve the right to redeem? Right to redeem is the right to buy back your stock at a specified price. That's good for the company, might be good for you depending on the price, have to negotiate that. Will you get some anti-dilution protection via preemptive tag-along and drag-along rights, the right to participate in future issuances of other shares? These are all things that should be on your radar screen that investors will want to talk to you about. Next slide, please. Bear in mind that all these things I'm talking about, you can accomplish, and this is a major disconnect, I think, out there. You can accomplish all of these things, address all of these issues in an LLC, just like in a corporation. Additional subjects in fashioning and documenting your investment. Are you going to have multiple rounds? Decide that up front. You may not know. Maybe you're only looking at right now, you need enough investment to get through your licensing phase. If you get the license, you'll go from there. Valuation, when you go out to investors, you're going to have to present them with a proposed valuation because that will determine what percentages or what they get for their money. Keep in mind your early money is your most expensive. You go out there and try and get raise capital without a license, you're going to pay a lot for it because there's more risk involved, obviously, to the investor. You'll hear some terms floated around out there, and these aren't set in stone, and there are no specific parameters. The pre-seed timing is typically the founders funding. Hey, you got together with your friends, and you all came up with 10 grand. There are 5 of you, and you got $50,000. That's your founding pre-seed funding. Seed funding is typically angel investors. Your family and friends are coming in with some more money, and then you will get into series seed rounds, they call them, and you'll see documents online called series seed documents, where those are rounds of funding after you've gotten more development up and running. And I've laid out there in the outline some terms that impact upon decision-making control rights, stock voting rights, typically 1 share, 1 vote, unless you provide for something different, which you can do. veto rights, board representation, matters involving approval of at least one investor, which you can carve out, non-compete, non-solicitation agreements of your investors, they can't compete with you, anti-dilution protection, very rare you're going to get that if you're an investor on a startup because it cripples the startup from raising money down the road. Do you want to give conversion rights upon an IPO? Well, that's not going to happen here. Or certain types of financing. What information rights are you going to give to your shareholders or members? The right to come in and look at the books and records, et cetera, right to get tax returns. In an LLC, all of these issues would be addressed in your operating or LLC agreement. In a Corp, you'll see these addressed in the certificate of incorporation, the bylaws, and an investor's rights agreement, a voting agreement, or a right of first refusal and co-sale agreement, just so you know that those are out there. Next slide, please. That's some of the general things. I know we're moving quickly now that you're dealing with in terms of investments and that you're going to see. Regulatory issues that overlay all of this, that bear upon your investors and who they are. Bear in mind that there will be criminal background checks at a certain level of investors. So if Al Capone shows up with a $10 million check and says, I want 20% of your company, and that's way beyond your valuation, you better say no, because you're going to disqualify yourself because he's got a criminal record. The statute also provides for a set aside of 30% of the licenses, 15% to MBEs, minority business enterprises, and 15% to women or disabled vets. So if you want to go that route and seek one of those licenses, you're going to have to qualify under the WBE disabled veterans or MBE programs. Going back to Ryan's discussion about the points, the statute provides, I'm curious to see what the regulations are going to say, that in terms of weighing experience, the commission will put the greatest weight on the experience of the applicant, and here's where it gets into investors, controlling owners, and entities with common ownership or control of the applicant, followed by the experience of investors with 15%. So in trying to maximize your points, weight against the money and how much money and the valuation, you may want to look at and consider investors with experience. There will be extra points in certain circumstances for New Jersey residents of at least 5 years who hold at least a 5% investment. Depending on your point calculation, you may try and get some of that with an investor. And then to the extent possible, the statute says the commission will grant at least 25% of the total licenses to applicants or those who employ 25% of employees from impact zones or municipalities negatively impacted by unemployment, poverty, or past marijuana enforcement activity. All those to keep in mind in trying to get more points. I don't know if you want to add to that, Ryan?
Yeah, I mean, the point system, there's definitely a lot of ways that you get points. As I mentioned before, the financial side of things is, compliance with 280E, compliance with banking regulations, how you're going to deal with, bringing on investors. These things all weigh in to the point system. And, if you don't have an established location, like Keith said, there's, impact zones that could boost your pointage. Just stuff like that. I'm not really, I haven't really dug into the point categories, except for the financial side of things where I can help. But a lot of this stuff has to do with zoning and other regulations that we leave up to the attorneys.
Okay, well, my point is that in terms of the attractiveness of an investor, it's not just the money in this case. They may bring value added by getting you additional points. Last thing I want to talk about is SEC Reg D. Reg D is a essentially a safe harbor when you're raising money and selling securities from the requirement of registering with the SEC. I'm not sure whether the feds will apply or enforce. I think they will. But when you're raising money, you have to be aware of these requirements. First of all, if you're raising under 1 million in 12 months, you pretty much get a free pass. And there's no need to create what's called a private placement memo, which is a big, long 100-page document of full disclosure to protect investors. If you're raising over 1 million in 12 months, you're going to need a private placement memo, which you don't want to have to prepare unless you go out to only what is called accredited investors. And accredited investors right now, and there's been talk about changing it, are people who make over 200,000 a year, have a net worth, or have a net worth of over 1 million, or if they're entities, there are certain other requirements. What we would recommend you do if you're in that situation, we prepare you a subscription agreement, which contains a bunch of representations and warranties, including the fact that your investor is an accredited investor. You also need to be concerned with securities fraud. There is a federal statute called 10b-5, which provides for cause of action for making material misrepresentations. There's also a common law cause of action for fraud and misrepresentation, which is why, in addition to the subscription agreement, we typically recommend that you let us look at your business plan or deck, so we make sure that none of your projections can be considered a statement of fact, and we put qualifying language in to make sure that it's clear they are estimates and opinions and subject to all kinds of risk factors so that you're not making a statement of fact. And lastly, there are state security laws called blue sky laws, which if you're out raising money, you will also need to comply with. In most states, and you have to comply with them wherever you're talking to investors. So if you're talking to investors in Montana, we're going to have to comply with their blue sky filings. Typically in most states, that's just a notice that you're selling. So you don't have to really file anything, or there's no disclosure, just a notice, but that's another consideration. So hopefully that gave you somewhat of an overview and is somewhat helpful. And I guess, Rachel, we'll go to questions now, unless you have anything else to add, Ryan.
I was just going to say, Keith, it was much easier when we could go to a bank and get loans. But in this case, it seems like we have to jump through a lot of hoops and comply with a lot of regulations. So another pitfall to getting into the industry. But, you know, if you could overcome these couple of pitfalls, taxes, investing, you know, it's definitely a thriving industry. So might be
well, especially with rates as low as they are, and you know,
right.
The advantage to a loan is you don't have to give away any piece of the profit, right? It's just a fixed rate.
Yeah.
You repay the principal plus the fixed rate of interest. So unfortunately, that's not going to happen here, at least not in the short term.
Right. Rachel, do we have any questions that came in?
Yep, we have, and again, everyone, now's the time to please write in any questions you may have in the chat box on the right of your screen. We had a couple audience questions come in live, and we also have a couple that have come in prior to the session. So my apologies if these have already been covered, but Keith, what kind of legal papers should investors get?
Yeah, I recommend, as I said earlier, in the very least, a subscription agreement. Bear in mind that Reg D requires you to provide to an investor all the information that they ask for. So attached to the subscription agreement will be, or in the subscription agreement will be a representation by the investor that they have received, if you're an LLC, and had opportunity to review the operating agreement and any other information that they ask for. If you're a Corp, a representation that they've been provided all of the other agreements that we talked about, if to the extent you have them, the investor agreement, the voting agreement, the right of first refusal agreement, a shareholders agreement, all of that stuff has to be available to the investor, and you cover yourself for, against a claim of securities fraud or common law fraud by having the investor give you a rep and warranty in that subscription agreement that they've seen all of that stuff and all their questions and any information they've asked for, they've seen. In addition, as I said, if most of you guys are going to prepare a business plan or a pitch deck, and you think that's a great marketing tool, I look at it as a lawyer as a defensive tool from a fraud claim. So you're probably going to prepare that, and you're going to want to huff and puff and talk about how great the company is and how your revenue projections, we're going to be making $1 million in the next 12 months. And let me massage it a little bit and make sure that it's clear those are estimates.
Great, thank you. Ryan, this one's for you. We are a provider of a storage display product solutions company. How do I reach out to the applicants who might require our services? Also, our company provides imaging solutions, asset tracking, digital asset management systems, along with installation.
Yes, I guess they're just applicants at this point. So there's really no way to tell who's applying and who's not. So when they do become licensed, I believe that's going to be public information. So at that point, you could probably do, Google search and just find out who the license holders are, reach out to them directly, and pursue them that way. There's also other ways you could go about doing it. I mean, you have the cannabis business directories, you have industry events, you can network online. There's a ton of ways to get involved in this industry. And you could also look at the current companies that are in the hemp and CBD industry, because a lot of them are trying to pivot into the cannabis space. So if you want to market to them now and get ahead of it, that might carry over to some opportunities later. So that's how I would go about it.
Great, thank you. Our next one is, many NJ entrepreneurs are looking to apply for a micro license. While this is not comparable to the application costs of regular license for most, it still involves doing a raise. For NJ legislation, micros have a cap of 10 employees, so these applicants are essentially applying to be running a small business. Is there a simple way these micros can be structured to start taking investments while maintaining the full control and flexibility they would have as any small business owner, yet still selling the dream of the big cannabis business?
Yeah, you can do that in your operating agreement if you're an LLC, or with your voting and investor rights agreements if you're a corporation. Basically, again, with an LLC, you can create voting and non-voting units so that the investors have non-voting units, or you can create that limited partnership structure where the founders are named as the managers and they run the show, with the other members, the investors, having no say in governance. Or a hybrid of that is that the investing members have a vote on certain specific major decisions, selling the company, borrowing a certain amount of money, et cetera. So you can craft that, and that's done all the time, so that the founders can maintain control.
And are there any will release?
I couldn't hear you on that one, Rachel.
Sorry about that. Are there any details on when New Jersey will release their application?
Well, I don't think that's going to happen until the regulations are in place, and so that depends on when the commission gets to that. The deadline is 6 months from now, so we'll have to wait and see.
Great, thank you. And we have 2 more questions. But I love everyone's time. Just a quick post New Jersey legalization, is there a benefit for a cannabis company to set up as a not-for-profit if the company does not expect to take on investors?
Yes, I believe under the old law, or the old statute in Jersey, they were dispensaries. The original 6 were required to be non-for-profit entities, and I actually worked on 2 of the 6, and the one company was actually paying New Jersey state tax for 3 years. I said, I thought you're non-for-profit. That means you're a tax-exempt organization. So we went back to New Jersey, and I amended 3 years worth of tax returns, got all the tax back, just because the accountant didn't set it up properly. So for tax purposes, I mean, you avoid the state tax. For legal purposes, I'll let Keith talk on that.
Well, I guess if you're not expecting any profits and you're going to pay out any proceeds through salaries, and you're not going to take on any investors, you could do that. Bear in mind that nonprofits do not have shareholders.
Right.
They have either trustees or members, and those trustees and members are not entitled to any economic benefit. The only way you're going to economically benefit is by salary. So if that's going to be your structure, it could work because you do get the tax exemptions, but that's definitely going to limit you in terms of developing and earning profits down the road.
And I want to be mindful of everyone's time. We'll get through a couple more questions, and the rest that we cannot get to will be answered separately by Ryan and Keith, and they can send an email. We do want to be mindful of everyone's time, so this will be the last one for today. Are there additional exceptions to Reg D when you are only raising from friends and family and not soliciting to the general public for capital?
Not that I'm aware of. It's based on amount being raised within a 12-month period, and that the words friends and family are not used at all. That's kind of a layperson's reference to the first million. We call that friends and family money, but the regs don't say that. It just says a monetary amount. If you're raising less than $1 million within 12 months, then you really can do whatever you want, subject to not committing fraud. Once you go over $1 million in a 12-month period, then you have much more significant limitations.
Great, thank you. And I don't, Ryan and Keith, do you want to answer the other three questions, or do we want to do it? I just want to make sure that we're good on time.
Where are you located? What are your hourly rates? Oh, I'm located in Whitney, New Jersey. Our hourly rates vary. Depends on what we're looking at.
Our office is in Newark. My office is in Newark. I haven't been there very much in about a year, but I can go there still. We also have offices in Camden, Jersey City, and Red Bank, and our hourly rates fluctuate. Mine is $500 an hour. We have associates ranging from, I think, $250 to $400.
I see that question about the micro businesses, how much they're allowed to sell. No more than 1,000 pounds of cannabis dry form in 1 month. 1,000 pounds sounds like a lot, no, Keith?
Yeah.
And then I see if a husband owned a dispensary and wife owned a grow, how would IRS look upon this? They would look at it as a dispensary and a cultivation business. So for the dispensaries, you got to watch out for 280E because the only expenses you could deduct there, the cost of goods sold. The only cost of goods sold for a dispensary is the product that you purchase. For a grow house, there's a lot more cost of goods sold, right? Everything that goes into making the plant, growing the plant, everything that goes into that plant, the farmer's salaries, the grow equipment, that stuff's all good expenses. So you have good expenses on the cultivation side, dispensary side, not so much. If that's what you're asking. If you want, you can reach out to me. We can talk. I think that's it, Rachel.
Looks like I see one more. I have a friend who recently awarded his cultivating license. Would I be able to work with another state to have flower retail?
I don't know the answer off the top of my head. Yeah. And we'd have to look carefully at the statute and the regs. And then the other thing that strikes me, if you're going to be transporting product from Massachusetts to New Jersey, you might have a federal issue.
Yeah.
Yeah. Interstate commerce.
Yeah.
That
could be a big problem.
All right. Well, thank you, everyone. your time and for sticking around. Our next webinar will focus on real estate challenges within the cannabis industry, and that will be on April 22nd. So invite to follow for that. But thank you, Ryan and Keith, and thank you everyone for joining.
Thank you,
Thanks,
Rachel.
everybody. Have a good day. Stay safe.
Thank you, everybody. Thank you, Keith. Take care.
Thanks, Ryan. Thanks, Rachel.
Thank you. Bye-bye.